So just really quick, for those of you that are listening to me, can you just let me know that you can hear me okay? And does my sound my audio sound okay? Great, awesome. Oh, hey, Sunny, good to see you here. All right, awesome. Okay, well, I'm going to go ahead and see if I can begin my presentation. My name is Jennifer Thornburg, and thank you very much for inviting me to present to friends at FX Street. This is my first time with FX Street. And I have prepared just a short presentation to share with you one of my favorite analysis techniques taken from my combo trade strategy. I'm going to share with you how I use 2 moving averages for meaningful information in trading, and it can be applied immediately to all trading. I only have 45 minutes today, so I don't have enough time to teach you an entire trading strategy, and I'm not going to, bite off, the whole pie in just 45 minutes, but I'm going to share with you something today that is extremely useful, something that I use in my trading every single day, and it's something that I hope you can immediately take away today and be able to implement into your own trading life and find some really useful information here. So I'm going to go ahead and start, and I'm going to try to leave a little bit of time for questions at the end, but we'll kind of see how the time works out. So today I want to talk to you about how I use 2 simple moving averages to answer questions that I have before I trade. So before you trade, you are going to ask yourself quite a few questions. You might ask the question, how far will price go in my favor? Will momentum be present in the market when I get into my trade, or am I going to end up just sort of sitting there waiting for something to happen and having an open trade and feeling like I'm just subjecting myself to risk? How much room should I give my stop loss? That's always a really important question to ask yourself before you take the trade. How much profit do you think you should hold on to that trade for, or how much do you stand to gain in this particular trade setup that you might be considering? How long should I be patient with this trade if it's not going in my favor? That's a great question. If you've been in the trade for a length of time, you might not really think, you thought maybe it was going to be done in 30 minutes, or you thought maybe it would be done within 1 week. Whatever the case may be, you might ask the question, how long should I be patient with this trade if it's not going in my favor? Should I just let it go all the way to my stop loss, or should I cut it off early? Another probably very important question that you might ask yourself when you're getting ready to take a trade is, should I go ahead and take this trade, or should I wait? And that is, if you've never asked yourself that question, that would be an important question to add to your list of questions that you go through before you enter into a trade, because almost at any given moment in time, you can go to any market and find a trade setup, and what we find is that obviously not all trades are going to play out perfectly, and so the question comes, should I take this trade, or is this maybe not the right timing, or is this maybe not a good enough setup, and those types of things. And I trade currencies. I also trade futures, but no matter what you trade, these are the kind of questions that are going to come to your mind before you go ahead and take your trade. So I have a simple technique that I'm going to share with you from my combo trade strategy. And this is a technique that helps me identify regular price action, helps me identify how fast I can expect price to be moving at any given time, helps me identify if price might be getting ready to change direction, helps me identify how much profit I should get at any given time when I enter into a trade, because it varies. Sometimes you get a lot, sometimes you get a little. Helps me identify a currency pair that moves in regular patterns versus a currency pair that's just really moving in a way that's more random and a little bit harder to anticipate. These are all really useful bits of information, particularly before you trade. They're useful bits of information that are going to help you as you're planning your intraday trading activity. So today, while I'm not teaching you a specific start-to-finish strategy, I'm going to teach you a technique that you can apply to all trading, whether you are a trend trader, a range trader, a swing trader, a scalper, a long-term trader, whether you trade futures or stocks or currencies. Currencies are my favorite. This is a technique of chart analysis. It's a way to very simply build a chart that gives you extremely meaningful information about what's going on in that market. And you will find that you are a much smarter trader when you can pull meaningful information out of your charts at a glance. So today I'm going to show you how I use two simple moving averages, and you can use any two simple moving averages. My favorites are the 50 and the 100 simple moving average. I actually call them the combo lines. But you can use any two moving averages. They do not have to be the 50 and the 100. You can pick your favorite two moving averages. All that's important is that you have one that's moving faster, a faster one, and you have a slower moving average. So my 50 simple moving average is the fast line. It's only considering the previous 50 periods of time, whereas the 100 simple moving average is a slower moving average. It's considering a much greater, it's considering double the amount of price bars in its calculation, and plotting a line that takes into consider much more data. The fast line is going to be the shorter or the smaller number, and it's considering a smaller amount of data, so it's going to take off and start, printing a line that moves much more quickly. So you can use any two. The only thing that I would recommend is that you pick your two favorites and then you stick with them. Don't change them around too much, because the more you look at the same thing over and over every day, the more you're going to be able to pick up on the behavior of price and how it relates to those two moving averages and how those two moving averages relate to each other. If you're changing them up all the time, then it's going to sort of take away your mind's ability to recognize repeatable patterns. So all this is going to be about finding repeatable patterns, and I start with two simple moving averages. And again, my favorites are the 50 and the 100. Doesn't matter. There's nothing magical about those two numbers. Simply, all that matters is that you pick your two favorites and then you stick with them. Don't change them up too often. And that one is a faster moving average that's considering a smaller amount of data, and that one is a slower moving average that's considering a much greater amount of data. And why would I use two simple moving averages? The fast moving average is giving me immediate indication. I got to move the questions box out of my way here. Okay, I'll come back to the questions box at the end of my presentation, so I'm going to close it for now. So don't think I'm ignoring you. I'm just going to try to stay on track and on time with my presentation, and when I get to the end, I'll go back and see what the questions might be. So why I use two simple moving averages, the fast moving average gives me immediate indication that price is on the move. It gives me, current information about what's happening in the market right now. It's going to identify when price starts moving in that current moment, and there's really, it's really going to change quickly, because maybe price bursts into action, because an economic release comes out or something like that, and it just identifies immediate indication of price making a change. The slower moving average is going to give you context, or it's going to give me a point of reference for the current price action. So I have something to compare current price action to. All right, so the slower moving average gives me context, and the faster moving average is going to give me immediate indication that we have change on the table. We have something happening. And it kind of looks like this. And I love to go ahead and look at a chart and pull the price bars completely off the chart, so it looks like a blank page almost. And all that you can see are your two moving averages. And so in this instance, I have the faster moving average is 50, and that's going to be this blue line. And the slower moving average is the 100 simple moving average. And that's, you can see that's making a change more slowly. It's still making changes as price begins to trend in the upward direction and maybe begins to change direction. And it's also plotting that same track. But the fast line is plotting it much more aggressively, and it's racing ahead much quicker. It changes direction and races below much quicker. And, I compare these to two Disney characters. If you've ever seen the Disney movie, Ice Age, there's two main characters in that movie. There's Manny, who is the woolly mammoth, and he's this symbol of wisdom, and he's plodding along, and he's big and cumbersome and slow, and he talks slow, and he's unimpressed with anything. He just plods along. And then there's Manny, who is the spastic character. He's the one that's crazy, and he's like, come on, Manny, we're taking off, we're going in this direction. And then changes his mind on a dime and says, oh, forget it, never mind, we're racing down this direction. And I always think of Sid and Manny. If you watch Disney movies, that might make sense to you. But we have the slower moving average that's just sort of plodding along. It's taking into consideration the big picture. It's calculating in reality, what it's doing, it's calculating price bars that take more data into consideration, whereas the slower moving average is just crunching numbers from a much shorter set of data, and it's giving you the immediate reaction to what price is doing right now. So if price is racing in the upward direction and then price turns around and now it's falling, whereas the slow line gives you context so that you can say, all right, this is a big change from what price had been doing over time. And not too surprising, the big change might even out, it may not actually have been a lasting change, whereas the slow line is going to give us more of a context for that move and say, well, that was just a big burst of momentum. Maybe we're going to continue in the upward direction, maybe we're not, but it just sort of gives you a more, mellow reaction to changes in the market. And so we have context for what's going on at any given moment. I'm going to spell that out in just a few moments, but in this next picture, nothing is really happening. You can imagine that price bars are very flat. There's not a lot of change going on in the market. So the black line in this instance is the slower moving average, considering more data, and there's really no change in the present moment, because the fast line is not making great gains, or loss. It's not really changing direction very much either. So the context is that for the longer period of time, we've been in a pretty flat sideways market, and even the slow line is indicating the same. Even the fast line is indicating the same message. And so you can anticipate just by looking at these price bars that this would not be the kind of market that you would want to trade, because we just have no activity, no momentum, no direction. Price is really just going sideways. And I don't know about you, but I don't like to be in a trade that's just going sideways, because then I'm just subjecting myself to risk and getting really nothing out of it. So when I get into a trade and I realize that the message from my two moving averages is that there is nothing going on in the market, I might just exit that trade and wait for a better opportunity. And I'll talk more about that in just a moment. But here is a demonstration where price is on the move. We have what I call shape and slope. We have some shape and some direction and some slope to the lines. They're not just flat and sideways, indicating that nothing is going on. We actually have some indication of direction, and we have some indication that as price in the current moment with the fast line is making a big change, the context is that in the bigger picture, it is trending in that direction. And so it gives you a little bit more meaningful idea that we have a trend to work. And whether you're a trend trader, a counter trend trader, a swing trader, no matter what your strategy is, this is the kind of information that's going to be meaningful to you before you trade, that helps you identify that this is the right timing to get into a trade, or if I'm a trend trader and I can anticipate that we're in an uptrend, and you might not want to be buying in this moment when the fast line is indicating that we might be pulling back or might be having a sell-off from that trend. Or if you're a trend trader and you're looking for the pullbacks to enter into, it's easy to see that price is pulling back or in a retracement phase off a trend, but it's hard to know when to get back in on that trend. And having two moving averages give you some context that the slow line says the trend is up. We have shape and we have slope. And the fast line says price is on the move right now. So we start getting some indication just from the moving averages that these are some good times to participate with your trend or your counter trend. Whereas when the lines start to flatten out, you might think, okay, I should just go ahead and hold off on trading right now until I have some more indication from my fast line and my slow line that I have price on the move, and that the context is, of that price action is such that it's going to create a pattern that I can anticipate, and it would become a better time for me to get into that trade. Don't worry, I'm going to become more specific in just a minute. I'm just giving you sort of a foundation here for looking at moving averages. And when you take price off your charts, it forces you to identify patterns in the market that you might be distracted by when price bars are there, and you can't help but see candle formations or dojis or spikes or large bars or small bars. But when you just start really focusing in on the moving averages, you start being able to identify different phases in the market that would be more ideal for your particular trading strategy, and more importantly, possibly most importantly, identify phases in the market where your strategy might not be ideal, and you might want to either switch strategies or just hold off until a more ideal trading formation appears on your chart with regard to the information that you get from your slow line and your fast line. So what information do I get from the two moving averages? Well, the fast line moves, but the slow line is flat. That's going to tell me that I might be in a range. So my slow line is flat. I'm going to show what that looks like. But my fast line is taking off, but the slow line is still really flat. We might anticipate that what we expect to see is a choppy market. So even though the fast line takes off, meaning price takes off in a direction, if that slow line is still horizontal and still flat, I might not believe that we're entering into any kind of trend activity. I might have to anticipate that price just took off away from the slow line, and maybe it's going to top out at the top of a range. Or I could anticipate choppy market behavior where we get the swing high, the swing low, the swing high, and it's very difficult to trade in that kind of a market. I call it the chop. It's very difficult to trade in that environment because you're going to get stopped out, and then price is going to turn right around and go back in the original direction. It's very choppy. How would I anticipate that choppy market? Well, I would see a fast line taking off, but the slow line is really still very flat. And the context is that I have sort of a burst of momentum, but the long-term information is that price is not really making a big change. And if I'm a range trader, this might be great news for me. I might be able to identify, have either continued or really early visual identification of a range that I could trade. And so when that fast line takes off, you remember Manny taking off, Sid taking off and Manny staying back, and pretty soon Sid freaks out and he turns around and comes racing back. And that really is what happens as a repeatable pattern that you can look for, especially if you happen to trade be a range trader in your trading strategies. Where another situation will be when the fast line moves and also the slow line is showing some slope in that same direction, identifying that we do have a trend on. And those trend traders have plenty of moves they can plan out in that instance to know that they can expect market activity. They can expect things that are not just going to go sideways. They can anticipate the retracement moves, which is a normal phase of a trend. They can anticipate the trend continuation moves. And it really all starts with an identification of the fast line making a move and the context that it has with what's going on with the slow line in that moment. So let me show you a few examples of what that looks like. So in this picture, we have the slow line is the black one. This is my 100 simple moving average, and you can see it's pretty much horizontal. It's a little bit wavy, but it's really not making any progress from left to right. Price has not really changed very much at all. Whereas the faster moving line, which is the 50 simple moving average, is the blue one. It might be, making more of an effort to extend itself away from the black line or extend itself away from the slower one. But not too surprising, it doesn't have a lasting effect here, because that black line, the slower moving one, the one that's considering more data, it just says compared to all these previous price bars, we're not making any progress at all. We're just sort of flat. And so even though price takes off in a direction, and it might be misleading that we're going to break out in a trend continuation, maybe continue going up, the information here is just that that slow line is just sort of really screaming for the context of we're not making any changes over time here. And so I'm still kind of on this flat track. And the anticipation would be a ranging market or a choppy market, where even though it looks like price is taking off, not too surprising, it just came right back down. So this is an example of the fast line moves, but the slow line remains flat, and I'm expecting this to be a range. So I'm expecting, even when price extends itself for a distance away, in this particular moment, when you don't really know what's going to happen, the indication might be that the black line is still demonstrating flat behavior. I'm going to expect from this distant level that we're just going to range right back down. So it helps you anticipate a pattern. It helps you anticipate a market phase. In this instance, it would be a ranging phase. If you're a range trader, that's good news. If you're a trend trader, the message from your charts or the message from your two simple indicators here might be, hang on, just wait. Go to something else. Come back to this later because this is not an ideal time to enter into a trend trade. Let's see a few more examples. Here's just another clip of price action. And you can just, in your mind's eye, sort of take away the price bars, and what do you see? You see really flat lines, both of them. The slow line is the black one. That's the 100 simple moving average in this instance. And it's identifying that even though it looks like, we might be building up some price activity, in one direction or the other, overall, the slow line is kind of indicating that, that we're flat. I might anticipate range behavior. So even though it looks like price is taking off, even though it looks like, the fast line is saying, hey, we got something going on. I think of Sid in that Disney movie just saying, oh, I'm so excited, something's happening, let's go. Come on, Manny, let's go. And Manny, maybe yes, maybe no, but this just could be, the lower distal portion of a range, and you could anticipate what comes next if this slow line doesn't, participate with the move. Here, next I'm going to show you some examples of when the fast line is sloping and also the slow line is on the move as well. And so we can expect a trending market. And when we have an anticipation for the phase of the market being in a trending phase, if you're a range trader, you would not have anything to do with this chart. You would say, okay, I'm done with this chart and I'm going to go to some other instrument that's ranging. If you're a trend trader, then you might be looking for trend continuation opportunities, or you might be looking for retracement, counter trend trade opportunities. But you're going to have some identification that the slow line is definitely clocking, or it's plotting along a visual representation of ongoing change in price activity. So it's continuing to climb. And as compared to all the previous price bars, we're still on the move in the upward direction. So in this instance, when we have the fast line really taking off and showing that in this moment, there's a big change to price, and the fast line is going to really be pulled away from the slow line, you can anticipate the counter trend move. You can anticipate that we have a strong trend in play, and where would be a good point of entry for my trend continuation move. But it just gives you sort of the green light for planning out your trend, counter trend, retracement phase, trend continuation phase, whatever it is that you trade. This is going to sort of give you the green light. And it's really interesting because we're not going to spend a whole lot of time waiting and planning for the next trend continuation move in the upward direction when the two moving averages very quickly change direction. They didn't really go flat, and they didn't really go into a sideways range. They just turned around on a dime, and we would have the earliest possible chance of knowing and anticipating the downtrend activity based upon the fact that we have the slow line confirming that we have a trend on, and the fast line, is moving faster with the current price and giving us those opportunities to plan for the downtrend. Trend continuation, counter trend, whatever your strategy calls for. And if you're a trend trader, you probably trade all of those things. And you didn't waste a whole lot of time trying to participate with the uptrend when you could have the earliest possible visual determination that the market has actually changed direction. Now we can start participating with this downtrend. Okay, so I'm going to go to the next slide and show you another example of something similar. In this instance, where we have the slower line, this is the 100 simple moving average, again, considering much more historic data, and it's coming up with plotting a line that is continually giving us lower and lower and lower values. And then we have price really racing lower, and as it does so, the slow line is going faster. It's making the change much faster than the slow line because immediate price action is showing us that. But we have context for what's going on with the fast line. We have context for what's going on with price at any given moment based upon the comparison that we have between the fast line and the slow line. So for example, when this one, it was actually another one that really turned in a hurry, you wouldn't really want to be continuing your downtrend at this point in time, thinking this was just a pullback of this longer trend, because now we have the slow line already showing some shape and some slope in the upward direction. So it gives you the earliest possible change of direction that you know isn't just you know, a pullback, or you know, you can sort of identify the retracement phase from an actual reversal just based upon what's going on with two moving averages that are going to give you context for market activity. All right, so now you know a little bit about how to use a pair of moving averages and how can we use that information. And you know, the answer in all trading is that we are trying to identify repeating patterns. You know, we're not fortune tellers and we're not gamblers. And so what are we doing when we're trading in the market? We're not guessing. I mean, we are guessing a little bit, but we're using educated guesses based upon the technical indications that we have on our charts, and maybe lining those up with some fundamental reports that might be coming out that we know we can anticipate when volatility might show up or when momentum might show up in the market, and we can be ready. But the answer for all trading is that we're trying to identify repeating patterns so that we can anticipate where price might be going next. If we see a pattern that shows up over and over in the market, and then we can identify a repeating pattern, then we can anticipate when that pattern might be getting ready to repeat again, then we have a trade. And that is the difference between a trade and just a guess or a gamble or just being random. You know, you buy or you sell and you have a 50% chance of being correct. It's really kind of what gives you the edge, is when you can visualize a pattern that you expect to see show up in the market. And the only way that you can anticipate and expect that pattern is if you have practiced being able to identify patterns that do repeat in the market. And the two moving averages are going to help you do just that. So whether it's ranging, whether the market is ranging or trending, it's constantly doing something that it repeats over and over and over again when it comes to using two moving averages. What it's constantly going to do over and over and over again, and I know that some of the people that are here that have worked with me in the past know what I'm about to say, is that price races away from those moving averages, and then price turns around and comes back to those moving averages. No matter what the time frame, no matter what the instrument, if you put a pair of moving averages on your chart, you're going to see the price races away and it returns. Price races away and it returns. Races away and it returns. Goes on a trend, comes back and returns to the moving averages, et cetera, et cetera, et cetera. Whether it's trending or ranging or in a choppy market environment, it does the same thing over and over. It moves away, it comes back, it moves away, it comes back, it moves away, it comes back. It's something that you can count on. It's an absolute certainty in this moment in time when price is really strongly moving away from those moving averages, that at some point in time it will come back. Now, of course, the moving averages are moving also, so it could just go sideways and price would come back into contact with those moving averages. But you have to understand that there is a pattern here that you can start anticipating, and you can count on it to be the case, that even if you're in the strongest of trends, you know that price is going to come back to those moving averages. And how do you know that? You know it because you just go back in time and you see how it moves. It goes distant from the moving averages and it comes back. And this would be one way to identify a trading instrument that is very regular and repeatable. It does the same thing. It's very reliable. It goes for a certain amount of time. Maybe it's a certain number of bars. Maybe it's a certain distance. Maybe it's one or the other, and it comes back and it snaps back. I have my favorite trading instruments, such as the Australian dollar, New Zealand dollar. That thing does not like to be away from its moving averages. So if you ever find it distant from those moving averages, you know it's going to snap back. It's just a repeatable pattern for that particular pair. Other pairs spend a lot of time right on top of the lines, and then they spend a lot of time moving away from the lines, and they might be more difficult to anticipate what it's going to do next. But the more you look at the history of that particular instrument that you're wanting to trade, the more you're going to be able to determine, yeah, this one is just extremely reliable. It goes for a certain length of time, or it goes for a certain distance, and it always just turns right around and comes back. So you can start to anticipate that repeatable pattern, and that information will benefit you whether you are a trend trader, a range trader, a swing trader, a long-term trader, a short-term trader. It just, you won't be able to miss the messages from these two simple moving averages. The simplest little charting technique will add so much valuable information to your day as you're trying to make these decisions about trading the market. Check my time. Okay, we're doing all right. Okay, so the most important thing about moving averages is that price moves away from them and then returns to them. That is the most important thing. There is all kinds of information you can gain from two simple moving averages. We talked a little bit about the slow line crunching a larger amount of data, so it gives you sort of the big picture idea of what's going on, and it's kind of like looking at a day chart versus looking at a 15-minute chart, which might be more like what the slow moving average is. It's considering a shorter amount of time, and so the moves look, you get the in-the-moment information about prices changing right now. You have context between the two. But the most important thing to remember about these moving averages is that price is going to continuously take off and move away from those moving averages and come back. Even if you're stuck in a range, it's going to move away from those moving averages, and you can anticipate when it's going to snap back. So if price is far away, if it's currently in a position that is distant from those moving averages, you can have a bias for direction, even if it's counter trend. You can have an idea that it's going to come back soon because price is really pretty far away from those moving averages in this particular moment. So even though that fast line is racing away, even if you're in an uptrend, you have some indication that you have a bias for what direction is about, you might have a bias for which direction market's going to go next. That could be useful to you when you're getting ready to take a trade. And if that bias tells you that price is going to go in the opposite direction that you are trading, that might give you an idea that you want to hold off on that trade. Or if you're a trend trader and you're looking for those retracement phases, you can either participate with that counter trend movement, or you can plan for the pullback that's about to happen so you know when to get back in on your trend. I mean, there are so many ways that this information can benefit you as a trader. And the better you are at analysis, the better you will be at trading, period. So even though it's boring and it's not quite as fun as teaching you a new fancy, exciting strategy that you get to, go immediately look for, every strategy has that percentage of losses, right? So this is just really the other important side of being a trader, is being able to anticipate what the market's going to do next, and then work that information into your trading strategy. Whether it gives you information that helps you enter a trade, or it gives you information that helps you maybe hold on a minute and don't take that trade, maybe come back a little bit later. Now, the other thing that could happen is that if price gets stuck right close to those moving averages and it's really tight to those moving averages, that's also important information. It means there's lack of direction in the market in that moment. Could be that we're in the middle of a range, or it could be that it's that pause that happens before we have a reversal and a new trend breaks out, or just a new leg of an existing trend. But in either case, when price is stuck close to those moving averages, it's giving us also very important information, and it is sort of like shouting to me, hey, lack of direction right now, lack of decision right now, I'm going to wait for more information. Super, super valuable when it comes to making a decision to hold off on a trade or maybe wait for a better entry. So here are a few of my favorite examples. In this instance, if you find that price is a long ways away, I'm going to demonstrate what I just said. If price is currently in a position where it's a long ways away from those moving averages, you're going to have a bias for direction, even if the market is trending up like it is here. In these moments where I've drawn these purple lines, you can start to anticipate that in this moment, price is very distant from the moving averages. And that's a bit unusual, right? I mean, how often is price that distant from the moving averages? And when it is that distant, it generally, what does it do? It comes back. So you can find those moments in present time where you can say, I'm going to measure how far away from these moving averages price is. And look at it, here's another spot that was distant from the moving averages, and we could have anticipated, the move that comes back. Now, in the present moment, you might say, well, how did you know, how did you know this was distant? In hindsight, you can see it because it does turn back. But in the present moment, how would you know how much space is, in quotes, a lot, right? That can be subjective, and I get accused of that sometimes. So I'm going to try to clarify a little bit. I'm going to measure the amount of space between the lines, and that's going to be my normal distance for any given chart at any given moment. So in this present moment, the amount of space between the lines is the normal amount of distance for this chart for price action in this current moment on this chart. So if price is farther away from the lines than the space between the lines, then it's distant, it's far, it's extreme, it's done something extraordinary. And that would just sort of help you have a measurement because, like some currency pairs like the pound dollar, Australian dollar, that thing covers a lot of ground in a small amount of time by comparison to the dollar yen or the dollar CAD. Those currency pairs are doing the same exact thing, but there's a lot less number of pips. So I can't give you a solid, if it is 70 pips, then it's significant because 70 pips on the pound Aussie is a sneeze. It's just nothing. Whereas 70 pips on dollar CAD might be a really big distance. So how would you know, and if you go to a new instrument or you go to a new market or you go to futures or you go to something that you haven't traded in very much in the past, how will you look at this for the first time and know what's a big distance? What's extraordinary? How do I identify that point in time where I can say price is now distant from its moving averages? And if you've never spent any time with this instrument, you might not be able to say what that number is. But I can say what it is because I'm going to measure the amount of distance between the two lines in any given moment. So in this moment, whatever amount of space is in there, that's the normal space. And if it's more distant than that, it's distant. And you can start expecting and anticipating that repeatable pattern that works with moving averages where price moves away from those moving averages and price returns to those moving averages. Okay, I'll just let that sink in for a minute as I check my clock. So we're almost to the end of my presentation here. Here's an example where price gets stuck to the moving averages. This is where it's telling me, hey, there is no direction. I have no bias for direction in the market right now. If you're a range trader, you might be able to pick the top and bottom of the range. There might be some things that you can do, but depending on what your strategy is, when you see price being really stuck to those two moving averages, we don't know yet what direction it's going to be. We know that eventually price is going to break away and make a move away from those moving averages and start to work a new pattern or start to work a bigger range. That can happen too. It doesn't necessarily have to break out into a new trend. But even if it's doing, big swings and then big swings the other way and big swings the other way, and we're not really having any trends break out, as long as it gives you enough space, you can start anticipating, even though the moving averages are flat, if the swings start giving you enough space from top to bottom, you can start anticipating that repeatable pattern and planning for, for the range that price is currently working. Super useful information. Okay, so another question that came up at the beginning was how much profit should I take? Because, it varies, and sometimes your trade setup is designed for a certain amount of profit, but sometimes it's not. How do you know how much profit you can take? And so it's all about finding that context between the fast line and the slow line. The fast line shows you what's happening right now. The slow line gives you context for how big of a change that is. And this gives you some indication of how much profit you might be able to make in that particular moment. So we're comparing the fast line to the slow line. It gives us context. So sometimes it's big and you get to take a bigger amount of profit, and that makes sense because that's what the charts are dictating. And other times it's just a small space in there, so really be quick to take that profit when it shows up before it slips away again. It's all about being able to anticipate what's going on in the market. So in this instance, where there's a large amount of space between the lines, you might anticipate a lot of market activity so that when you take your trade, you expect there to be some follow-through on whatever direction you're trading. Whereas when there is no space between the lines, it really is it's a very choppy market where it swings high, it swings low, it swings high. And you can range trade it. You can trade that chop. If you're a talented trader, you go right ahead. I'm not saying you can't. You can, But I am saying you want to take your profit off the table a lot quicker if there's no space between the lines, because there's really no telling how much price is moving or reacting until you have some context for current current price activity as compared to what the bigger picture line is telling you. When there's a big difference between the two, you can expect swings high and swings to come back down low. And I'm expecting that whatever I'm trading, either the trend continuation or the retracement phase or whatever your setup is, the amount of space between those lines, that's how much profit I'm looking for in my trade and not more. It really does give me a great indication of how much I can anticipate I'm going to get out of the market. Remember, Sid and Manny. Sid is racing away, Manny is slow and steady. And when there's a big space between the two of them, that's pretty much a good indication of how much, what the mood is in the market. And if Sid is in this hyper mood where it's racing away and racing back and forth, as long as there's a good space between what the fast line is telling you and what the slow line is telling you, you know you have a very good chance of capturing that much profit in your trade. Okay, so we'll review quickly. 2 moving averages produce meaningful information. We have a fast moving average, and that is the in-the-moment information about price action. And we have the slower moving average that gives me context so that I can see how big of a change the new price action really is as compared to what's been going on over the longer period of time. I have reference for when price might come back to a moving average or to a mean. I also have reference as to whether a trend is breaking out or it's just sort of, I can expect a choppy marketplace. It's so important to be able to identify that and anticipate. I'm not going to be lured into this being a new trend breaking out when I have a pretty good indication that this is just going to be the chop and it's just going to swing right back. And I can either use that to promote my trade strategy, or I can use that to keep me out of a trade. All right, so that is the end of my presentation, and I want to let you know where you can find out more about how I trade. This is my website, http://jennifer.bz. I do run a live trading room Tuesday through Thursday. We set up combo trades using these 2 moving averages every single week, and most weeks we find between 1 and 3 trades. You can try it out for $1 for a whole week, and after that is a membership, but you can cancel, and it will cost you no more than $1 just so that you can see if you like it or not. If you're interested, visit my website where you can take advantage of that, that trial. And I also have a online education. I have a self-serve online course called the Combo Course, which you can also see at jennifer.bz if you want more of this type of training for how I use these simple and freely available indicators to do market analysis every day. All right, I'm going to try to pull down the chat box again and see if I can quickly answer any questions, and I think we only have a few minutes left. So I am anticipating that the host will let me know when we're out of time. Awesome. Well, thank you for your thank you for joining me, and I'm happy to share all this cool stuff with you. And I gave you the website, so Chris, I think you got that, and I'm looking for more questions. You can use this exact same analysis technique to look at oil. I particularly like it on crude oil and gold futures. That's where my experience is beyond Forex. But all of this market analysis comes first from the stock markets. And so it certainly is, all it is doing is it's giving you reference and context in any marketplace. So it's really an ideal way to, at a glance, be able to sum up what's going on in any market on any time frame. I mean, how cool is that? Seriously, you're going to get a lot smarter in a very short period of time if you have some proficiency just using 2 moving averages. I mean, it's the simplest thing ever. And all of the complex things that you're going to hear from other people in the market, and all of the complex strategies and indicators, and you know, my screen looks like a blank page practically compared to other types of analysis that are available. And if you ever just lose your way out there and you just need some, like, you know, tell me what's true in this moment, you know, just peel off some of those layers and just go down to 2 simple moving averages, and you can start identifying repeatable patterns, being able to anticipate what might be coming up next, keeping you out of a trade, confirming that you're in a good trade. You know, all of those kind of things sort of help bring peace and calm to the mind of the trader. So that is it. That is all I have to share with you today. I don't see any other questions, so if I missed your question, because it's hard to scroll all the way back, just go ahead and let me know. Otherwise, you're welcome, and thanks to you too, and thanks to all my friends that I see names that I recognize, and it makes me feel calm. It makes me feel loved. So thank you to FX Street for your invitation. It was a pleasure to be able to participate with your friends on FX Street today. I hope to see you again soon.